Hello, May is here, and at the start of May there's at least two things happen on an annual basis. One is that the weather thankfully begins to change. After last week's blizzard here in Zurich, things beginning to look up, temperature is rising. And secondly, financial journalists begin to write articles with the heading "Sell in May and Go Away." And the full phrase actually is "Sell in May, go away and come back on St. Leger's Day." St. Leger's being a famous horse race takes place in the UK in the middle of September. So should you sell and go away for the summer, or should you do something completely different? There's maybe two or three reasons to be concerned. One, I think valuations for risky assets are pretty high. They're high for high yield bonds. They're high for US equities. Also, we've seen a dip in macro momentum in the last couple of weeks. What I mean by that is that a lot of the macro data has not been coming in as strong perhaps as expected, and that I think if anything just shows that expectations have risen at the same time. Thirdly, one thing to keep an eye on is yields and interest rates in China beginning to rise as the authorities there try to take some of the steam and the heat out of the property sector, and also some of the financial products in the banking sector there. Keep an eye on that as a story to watch. However, I think the story of this year so far has been the market, the bond market and the equity markets focused on the business cycle almost to the exclusion of politics. There have been times and instances when the market is focused on politics. As I record this, we're heading to the second round of the French presidential election. It now looks pretty sure that Emmanuel Macron is going to win, and I think the focus again for the markets will be on the steadily improving business cycle in Europe. And typically, when the business cycle is in recovery in Europe and the US and emerging markets, riskier assets tend to perform well. Real estate, commodities, equities, with government bonds performing less well, and we would expect the same kind of behavior now. So I think our advice would not be to sell in May, but just to stay in May. Keep the lion's share of portfolio positions in place. Our portfolios actually have had a very, very good start to the year, but maybe begin to work around them. And I'll give you a couple of ideas. One is switch out of US equities into European equities. The valuation case for doing that, I think, is quite an easy one to make. Also, Europe, the business cycle, I think, is better in terms of its momentum, and Europe maybe is at an earlier, more promising stage in the business cycle than the US, which is now, I think, beginning to get into the later stages of the business cycle. Secondly, in FX, we have been long the yen, and it's just come back now to the 112 level. 114, I think we had thought was a very, very good entry point. And the yen, I think, in a portfolio is quite a good hedge against geopolitical risk and also trade tension. In fixed income, we stay focused on corporate debt, corporate bonds, financials debt. You still get quite a nice yield and cash flow pickup there. And then finally, about the only asset that is cheap at the moment is volatility. So if you are worried about May and worried about the sell in May maxim, the best thing to do is use cheap volatility to put a hedge in your portfolio, and that would pay off if volatility, for whatever reason, does indeed rise. Thank you.